folks. Dan Frio here with your closing bell for March 27th, 2025. I feel like a broken record. It's like every day we got tariffs and wars and all this other stuff. And today's kind of the same thing. So if we go over to mortgage rates today, they basically haven't moved at all. The Dow Jones and everything there in the red again because of tariffs and all the uncertainties. Bond market's up as well. And then we have the PCE coming in tomorrow, and it's going to be a huge day. So let's get over to it. My name is Dan Frio, and the reason why you're watching this video is you're trying to figure out what's going on with real estate, especially mortgage rates and mortgage programs. I'd love to be able to help you. Our slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. I would be your loan officer during that whole transaction, but I'm going to explain to you how that works at the end of this video. So without further ado, let's get to today's news. Well, mortgage rates, they ticked up just a little bit today. It's kind of like, it seems like the calm before the storm, not in the equity markets. Well, this might be up tomorrow or down tomorrow tremendously based on one piece of information that we're getting tomorrow, and it's right through here. Okay, so what we're going to look at next is the PCE. Now, the PCE, why it's important is if you go over to what the Federal Reserve monitors, and I go over this as well every day, folks, we're going to get this information coming in tomorrow right through here. So usually once a week or once every other week, we'll get one piece of this information. Well, this week, we actually had two of three of these. So we had the GDP come in, and that actually came in a little bit lower than it was previously, but it's still in positive territory. The unemployment rate came in, I think 2 weeks ago or last week. It actually ticked down from 4.2 to 4.1. And then we have the PCE coming out tomorrow. Why is this so important? Well, it's the number one factor that the Federal Reserve monitors, and that's the concern of us. What's the Federal Reserve going to do next time, and what's the interest rate market going to look like? So let's get over to this section right through here, and I'm going to give you kind of an analysis of what's going to take place tomorrow, either which way happens. So tomorrow we're going to get the PCE, and like I said, it's the number one inflation number that the Federal Reserve monitors. Okay, so when we're looking at this, I hope you can see that. Let me get my head out of the way if you can't. So if we're looking at this, we're going to see core PCE month over month. And then we're going to have core PCE YOY. That means year over year. Then we're going to have PCE month over month and PCE year over year. Okay, what does all this mean? Well, all you need to know is this is the inflation numbers that the Federal Reserve looks at. The core means it strips out food and energy. And then there's YOY means year over year, and MOM means month over month. So the core reading last time was 0.3. It's expected to come in at 0.3. The core PCE year over year was 2.7. They're expecting it to tick up to 2.6. Okay, well, then we go to the PCE indexes, and again, month over month and year over year, we had 0.3. They're expecting it to stay at 0.3, and then 2.5 year over year, staying at 2.5. Now, here's my question with this, and this is why I'm hoping these numbers are wrong tomorrow. Because if we look back last week, or I think the week before, we had the CPI number come in, and the reading was 0.2 lower than expected. And we also had the producer prices come in, and they were 0.2 light. So that kind of really didn't shock in all the market because they were waiting for these numbers to come in over here. So if both those numbers came in lighter, well, my expectations would be the PCE is going to start coming down. And we also had some numbers today on the housing. It's rent to housing equivalent on the CPI. It's just some inflationary numbers in regards to housing. Well, that number makes up 40% of the consumer inflation. It's actually down considerably from where we were a year ago and 2 years ago. So you're going to start seeing the PCE drop tremendously at some point. It's when those numbers start to kind of roll into the system. So I'm expecting these numbers to be either on point tomorrow or below. Okay, so what's going to happen if that happens? Well, the markets are kind of poised for that, I think, to happen. I don't think there's a lot of movement on the downside for mortgage rates and bonds at this point because of all the uncertainties. But the biggest concern I have now is if this number comes in just a tick higher, what's the market's going to do? Because it's already skittish. Because if you go over to the equity markets and you look through here, if you look right over my head, there's a thing called the VIX. Okay, what the VIX is, all you need to understand on this, it's kind of like, tracking the bond market here, and I'll show you how to track that in a second. When you're tracking the VIX, if this number is up, and if it's up above, let's say 10 or 11 or 12, that means the market's getting a little skittish. When you get up to 18 or 19, it's really skittish. Well, last week we were in the 20 range, and now it's down a little bit, but it's still not a comfortable level because if you just have one little thing come out of the ordinary, like tomorrow's PCE, If it comes in out of the ordinary, well, you're going to see the equities markets just crash from there, and you're also going to see mortgage rates jump. So my concern is for those out there that's, like a phrase I always say, pigs get fat, hogs get slaughtered. And what I mean by that, it's no disrespect, but a lot of people, I have some clients that are like 7.5%, 8% interest rates, and we can get them like 6.9 or, I don't want to say 6.9, 6.5. We have some government products down in the low sixes. You have to balance, what your costs are and your benefits, but please don't keep thinking rates are going to get back in the fives anytime soon. I don't think it's going to happen, folks. So this might be an opportunity for you to get out of a high interest rate mortgage at this point. Or if it's an entry point for you getting a new home, rates are a little bit lower than where they were last year and considerably lower than where they were 2 years ago. So that's what's happening right through here. So now let's get over to this. And we have CNBC's comment today in regards to housing. So let's see the health of the housing market and what the data is behind the scenes. So we're going to go over to Diane Olick over at CNBC to see what she has to say on housing.
Pending home sales out a couple of moments ago with Diana Olick. Morning, Diana.
Carl, pending home sales in February rose 2% month to month. The street was looking for a 1% gain. But just for context, January was the lowest read on record for this index. So now we're 2% higher than that. Sales were 3.6% lower than February of last year, all according to the realtors. Now, this count is based on signed contracts. So people out shopping and inking deals when the average rate on the 30-year fixed was dropping from just over 7% to 6.75%. It is at 6.8% today. Regionally, pending sales were higher in the South and Midwest, lower in the Northeast and West. The West is at the weakest level. Of course, that is where home prices are the highest. But back to that national sales picture, I just want to mention sales were significantly lower than a year ago, despite the fact that the supply of homes for sale is up nearly 28% from a year ago. The problem is both affordability and uncertainty over the broader economy and employment. We've also seen personal debt levels rise, which of course makes qualifying for a mortgage even harder. Sarah?
Okay, Diana, thank you very much.
So that's the read on housing right now. Unfortunately, house prices, they continue to go up, as you basically saw on here. And then the toughest thing right now is homeowners insurance. So if you're out there and you need, you're looking at buying a house, check in the homeowners insurance before you start moving forward. Or if you're in an existing house right now, reach out to an insurance broker and see if you can get some insurance quotes from different companies. But please, make sure it's a reputable company out there. So that's what we have so far in the data today. So tomorrow, like I said, the biggest news coming out is right through here. The PCE numbers coming in and personal spending. I'm expecting that to be a little bit lower than expected. I think people are starting to really tighten up right now just because of the unexpected things coming up. That's what we're seeing right through there. Next thing is the CME Fed Watch tool. We also go to this. I'm going to start going to this 2 or 3 times a week, not every day, but what this does is for anybody new out there that's watching, we go to the CME Fed Watch group, and this actually is telling us what the Federal Reserve is supposed to do over the next year. Well, my biggest concern is I don't know what they're going to do next month. But let's go down through here and we'll just check this periodically. You have to understand right now the federal funds rate, well, it's the only rate the Federal Reserve controls. Right now it's 4.25 to 4.5. There's a 0.25% spread. So if you go over through here, we're going to look at the probability. Let's look at the probability of what this is going to do over the next year. So if you look through here, there's the rate right up through there, the federal funds rate. So we're right in this category right here. And then you can see the dates all through here. Well, I don't really care what's going to go on in December of 2026 because the Federal Reserve even came out and said, we really don't even know what they're going to do at the next meeting. So they're going through here and there's an 87% chance the Federal Reserve is going to do nothing at the May meeting. And now what they're saying is, we're probably a little bit over a 50% chance we're going to cut in June. Well, what's going to happen from then? We're going to have to, hopefully the tariffs start to settle. You're going to start seeing the jobs markets, maybe settling as well because of a lot of immigration getting taken out and new employment needed and just a whole bunch of different things in the workforce. So there's so much uncertainty right now that's why the markets are doing what they're doing. So it's not normal times. So you just have to keep up, with the beat. So that's what we're seeing in today's market. But again, mortgage rates, they were just up a tick today. The Dow Jones and everything, they were down. I won't say they were down huge, but the Dow Jones was down 150. Let's see what cryptocurrency did for the day. It's up $1,000. We want this thing to get to 100 grand. And then you go over to the bond market and right through here, here's what we follow on this channel. We follow the mortgage bond. And the reason why is a lot of people, they follow the 10-year Treasury if you ask them. And it's like, why not just follow the mortgage bond? Because the yield on this thing is exactly the yield on which your mortgage is. Well, there's other things that are added to this. So the banks take this yield and they add on what's called LLPAs. And I'll maybe do another video at this another time on that. And then they put in their profit margins. And that's what creates your interest rate. So we follow the yield on this thing. And the best way to watch this is, well, it's easy to explain. If the price is going up, that means rates or the yield is coming down. So we love when this thing's going up. We hate when it's going down. You look at a 2-day chart, look at it. Look at a 5-day chart. Well, it's going down. What's that mean? Interest rates are going up, folks. So that's what we don't want to happen. So let's see what happens tomorrow when it comes to the inflation numbers. This will be a market mover unless it hits spot on. But I'll let you know tomorrow morning at the opening bell how this comes in, and we'll also see immediate live market reactions at that time. So my name is Dan Frio. I hope you enjoyed this video. And if you did, here's what I am. We have this slogan, one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, how do we do that? Well, I'm actually a mortgage lender, or I actually work at a federal bank, so that makes me federally licensed. So I'm licensed in all 50 states as well as Puerto Rico. And the cool thing is we're also set up with 32 other lenders. So I can offer you all of my products as well as theirs. And you just use me as the loan officer through the whole transaction. How do you get started? Well, the first thing I want you guys to know is before you put in an application for a mortgage or a car, please go to optoutprescreener.com. If you sign up for the do not call list, this is kind of the same thing. The credit agencies created this thing and it's free to do. You can sign up for this because what happens is when a mortgage company pulls your credit or a car loan company pulls your credit, the credit agencies at that point have the ability to sell your data, your financial data and your credit scores. You want to stop that? Go to optoutprescreener.com. But if you want to reach out to me, how do you do that? Well, go to the rateupdate.com. You can do one of 4 different things. One, you can click on the application link right up through there and you're on your way. Some people get leery. They're like, Dan, I really don't want you to pull my credit or things like that. Folks, we won't. What happens is when you put in your application, I'll give you a call and we'll go over any questions that you have, make any concerns, make sure you're all cleared up, and then we'll move on to the credit section. If you want to schedule a consultation with me, you can schedule right up through there. Or you can scroll down to the bottom of my website and you'll find my 800 number as well as my email address down below. So it's 844-775-5626, or you can reach me, Dan, at the and please send your questions here. If you have a question, please leave it up here. Don't leave it down there. I only check down there periodically. But if you really want your question answered, and I'll probably give you a phone call, so don't be surprised. Shoot me an email. So thanks for watching, guys. God bless. I hope you learned something today. I'll be back tomorrow to see how this mess starts another day. Take care, folks. See you then. Bye-bye.